What is going on, YouTube? How we doing? Hope you guys are doing great. Today's a really special day for me because I am finally publishing my first stock video here on YouTube. And when I was thinking about what stock I wanted to talk about, I couldn't help but think about the fact that Charlie Munger had just bought Alibaba. Now, if you don't know who Charlie Munger is, he is Warren Buffett's right-hand man. And he is 97 years old, guys, and he is still reading 10Ks and investing. Needless to say, this guy has been through the ringer. He knows what he is doing. In fact, I look up to this guy so much, I read his book every January just to refresh myself on his investing values and ideas. But needless to say, I don't want to get off track too much here because I could easily nerd out over him. So let's just start talking about Alibaba. And then if I think it was a good purchase, which my opinion is probably meaningless compared to if that guy invested in it, but I wanted to give you guys my thoughts on what I think the stock is worth, give you some context as to why maybe Charlie invested in it. I do think he saw a certain section in the 10K that stood out to him. And yeah, let's just unpack all this. Now, the first reason I got really excited when I saw that Munger had bought into Alibaba is because I thought it was in my circle of competence. I used to work in digital marketing. I used to post ads on Amazon. I kind of get how those platforms work. So I immediately got the 10K and started digging into the business segments. And one thing I want to say, guys, before I get into the details of that, is that if you are kind of new to investing, it is so important to actually read about what the company does. I'd say the first thing is look at the industry it operates in. If it's something like pharmaceuticals, I'm not even gonna touch it because I have no idea of valuing it because I don't understand it. As you're going to see in a little bit, I did plug some numbers into my spreadsheets and I got intrinsic value. I see so many people make the mistake of just pulling numbers from Morningstar or any sort of online service that provides the financials of a company, and they haven't even read the 10K. Like, they don't even know how the company got those numbers, which business segments did what to put that company in their current financial position. And guys, I honestly think that is like one of the biggest mistakes an investor can make, because if I didn't read Baba's 10K and I just did an intrinsic value assessment with just the simple plug and chug, I would probably think Munger made a mistake based off of what he bought the stock at. However, if you read the 10K, you can uncover some magic stones, and that was a weird term. You can unlock hidden value. I advise you, like, if you just want to get a surface level intrinsic value of a stock, it's okay to just do a quick plug and chug. Don't ever purchase a stock without reading the 10K, like, at least 2 times. So like I said, guys, I honestly at first thought Munger might have paid a little bit too much. Not a lot, but a little bit too much for this company. But naturally, I was curious because Munger has only made, I think, 5 investments in like the last 10 years. Something ridiculous. Might not be that. Don't quote me. But I was like, okay, what did he see? What can I learn from this decision he made? So I was going through the 10K and eventually I got to the different business segments that Alibaba operates in, and you know what they're investing in, where they get most of their revenue. And there was one section that just stood out so much, and it made me rethink about a clip I watched of both Buffett and Munger talking about how one of Berkshire Hathaway's money managers, it was either Ted or Todd, it wasn't Warren, but it was one of the other 2 managers, made an investment in Amazon at a ridiculous PE ratio or valuation. And then I edited the clip, but then Munger talks about how he feels he made a mistake of omission by not investing in Google and Google AdWords. So I'm just gonna play those 2 clips back to back really quickly, and then we're gonna unpack it and how it relates to Alibaba.
Value decisions that built Berkshire.
Yeah, it's interesting that the term value investing came up, because I can assure you that both managers and one of them bought some Amazon stock in the last quarter, which will get reported in another week or 10 days. He is a value investor. The idea that value is somehow connected to book value or low price earnings ratios or anything, as Charlie has said, all investing is value investing. I mean, you're putting out some money now to get more later on, and you're making a calculation as to the probabilities of getting that money and when you'll get it and what interest rates will be in between, and all the same calculation goes into it, whether you're buying some bank at 70% of book value or you're buying Amazon at some very high multiple of reported earnings.
Well, Warren and I are a little older than some people, and
Damn near everybody.
and we're not the most flexible, probably in the whole world. And of course, if something as extreme as this internet development happens, and you don't catch it, why, other people are going to blow by you. And I don't mind not having caught Amazon early. The guy is kind of a miracle worker. It's very peculiar. I give myself a pass on that. But I feel like a horse's ass for not identifying Google better. I think Warren feels the same way.
Yeah.
We screwed up.
He's saying we blew it.
So if you watch the rest of that clip, it's like 4 minutes longer, I think. You'll hear Charlie talking about how he makes the biggest mistake with missing out, not so much on Google as a whole, but Google AdWords, that segment of Google, which I think actually at the time was pretty much the only way Google made revenue. Now it's all over the place. But with that in mind, I was reading the 10K and I saw this segment that was basically the same thing as Google AdWords, but for Alibaba's platform. So I'm gonna try and put up a screenshot of this segment of the 10K here on the screen. But this is a segment that is called Customer Management, which in my opinion, when you read the description, which I'm about to for you right now, sounds very similar to like Facebook advertising and Google advertising. So the description of customer management, which is basically Google ads for Alibaba, in my opinion, states, we derive a majority of our China commerce retail revenue from customer management, which primarily consists of P4P marketing services. And P for P is pay for placement or pay for promotion. I don't know which one it is, but it goes on to say, this is where merchants primarily bid for keywords that match product or service listings appearing in search results through our online auction system on a cost per click basis or a CPC basis. Now, if you were to read the rest of the description there, they go on to talk about how they also do display network advertising and how they are investing heavily into that infrastructure. And if you don't know what display ads are, it's basically like when you go on Instagram or Facebook and you happen to see ads for like a website you visited 2 days before. I know it's creepy. Or when you go on a blog of some website and there's ads up in like the banner area. Those are usually considered display ads. And Alibaba, if you read the section on R&D, they have been investing heavily into that infrastructure, which means they're trying to create a platform for those display ads that become basically even more creepier than what they are now. So they want to come up with a bidding system that knows just the right time to put those ads in front of you when you're most likely to purchase the product that's being promoted. And guys, it actually looks like I have some notes here that I jotted down just before I recorded this on the financials. It looks like they're doing a really good job. From what I saw, it looks like they're growing this P4P customer management segment. I think it's a really weird, inaccurate way to describe that business segment, but it looks like they're compounding that revenue growth at 15% for the past 3 years. And I think that's actually going to continue to grow. Now, another thing I wanted to mention is that, fun fact for those of you that don't know, Amazon actually doesn't get the majority of their revenue from the e-commerce store. It's actually from Amazon Web Services, AWS. Alibaba is starting to tap into that segment as well, the cloud computing segment. Personally, I don't know anything about that. Like, I didn't even look really too much into attempting to value that business segment of Alibaba because I just don't really understand it. Like, I get it, there's Google Cloud and whatnot, but I don't really understand how to make that business segment even more successful. I'm no software engineer, but and I doubt Munger, him being the 97-year-old he is, bought Baba for that reason too. He has come out in the past and said many times over that he is old and is not good with technology. So if I'm guessing, Munger is banking on Alibaba's current business model and them expanding on these advertising capabilities. But anyways, enough of me rambling on about me trying to be as smart as Charlie Munger. I know I'm not. Let's go on over to the computer. I'm gonna try and do a screen recording. I've never done one, so you're gonna have to bear with me. Before we actually do that, I wanna just tell you, make sure you do your own homework. You're gonna see the price I think it's worth. It's not financial advice. I'm just a random 24-year-old. I'm not a professional, blah, 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 blah. Okay, got the disclaimer out of the way. Let's go check it out. I think I got it working, guys. This is my first time ever doing a screen recording. Like, I already messed it up. Look at this. I watched like YouTube videos on how to do this before. Float to top. Okay, yeah. Now you can see me. Not the most tech savvy. But anyways, let's talk about how to value a stock, and in this case, how to value Alibaba. So the first thing I want to say, guys, is when you go to value a stock, there are multiple ways you can do it. There's probably like 5 or 6 different ways I value a stock when I start getting serious about it. Today we're going to talk about just a simple discounted cash flow and payback time, how long it's going to take you to get your money back based off of how much it costs to buy the stock today. I'd say the discounted cash flow is probably the most common way to value a stock, and when I took my finance classes in college, like chapter 2 of my first finance class was discounted cash flow. And it's interesting because I can't tell you how many people I know who are my age who work at these big investment banking firms and like hedge funds even, that don't even know how to do a discounted cash flow. So if you can learn this, you're halfway there. But anyways, I'm gonna run through this as efficiently as I can because I don't want the video to be too long here. But anyways, we need to get some numbers to start here. So the first thing I like to grab is the enterprise value, and that is basically how much it's going to cost to buy out the entire company right now, today. And I'm using Ticker Terminal right now. I'll leave a link in the description if you want to check it out. It's really cool for pulling the financials of companies. If you start getting serious with a company, you should probably get the numbers from the 10K or the annual report, but for time's sake, we're just going to use this number right here. And if it's an American stock, it's going to show you the enterprise value in dollars, but this is obviously Alibaba in China. So this is actually in yen, so I had to convert it back to dollars. And right now, the enterprise value of Alibaba is about 88.2 billion. Next thing we need to know is the free cash flow, which all we need to do there is go to financials, load, and then we go to, oh wait, no, I need the cash flow statement. Told you guys, bear with me. And then we're just gonna go cash from operations. Then we're gonna take out capital expenditures. This is a very simple way to do it. It's not the most accurate in my opinion, because if you really want to know the true free cash flow to equity holders, you need to add back a lot of things and take out a lot of things like depreciation and whatnot. But we'll just pull that number for now. It's close enough. And then the next thing, this is where, in my opinion, valuation is not a simple formula where you can just plug and chug as it appears here. Valuation is both an art and a science, in my opinion. You really need to know the business and apply critical thinking to come up with these numbers. And as news about Charlie Munger coming out and buying Alibaba stock has gained traction, I've seen so many videos with individuals who are trying to value it on YouTube, and I've seen some videos where they're putting a 40% growth rate for years 1 through 5, and some, and then like 20% for 6 through 10, which I think is pretty aggressive. I mean, I don't even think Amazon has grown that much, so, you know, it's a little liberal in my opinion. And then I've seen some as little as 10 and 5% respectively, but I've read the 10K like twice now, and I've been following Alibaba for a while, and I know quite a bit about it. I used to work in digital marketing and e-commerce, and I get it. And I think 20% through years 1 through 5 is fair. I usually don't apply a growth rate higher than 20% ever. I'll cap it there for years 1 through 5. And then I'm doing 12% through years 6 through 10, which I think is fine. And then the next big question here is the discount rate. And this is essentially what rate of return you need for this investment to make sense. And normally I go 15%. I'm pretty stingy there. I have high standards. But Alibaba, if you look at their Rule 1 score, which is a Phil Town way of looking at a company, if you don't know who Phil Town is, go read his book, Rule 1 Investing. It's where I started. It is like the beginner's book for investing, and I would not know nearly as much as I know today without both of his books. But essentially, you can see that they've just grown book value, earnings, cash, sales for the past 10 years, and they're doing a really good job at that. And not only that, they're really good at reinvesting their earnings. They don't pay a dividend, so that means they take all of their earnings and reinvest it into projects. I touched on that earlier in the video, how they're investing in their infrastructure and cloud computing stuff. So they do management's doing a really good job at that. The other thing is they have really low debt, which we'll see in a second, relative to how much in earnings they make. So that's a really good sign. So I'm willing to give Alibaba the benefit of the doubt. You can kind of think of a discount rate kind of like a credit score. If they have really good numbers like that, that means they're solid. It's like an 800, 850 credit score. So we can give them a little bit of a break. The next thing we're going to come up with is the terminal value. So this is how much we want to, what multiple we want to add to the free cash flow in year 10. Pulling this number out of thin air, again, is not my preferred way of doing it. And I'll probably have to make a second video if you guys are interested on how to value this company in its entirety. But again, for time's sake, we're going to go with 15. Monish Pabrai recommends a terminal value of 10, but if it's a great company, which Alibaba is, you can go up to as much as 15. So I'm going to give them the benefit of the doubt, really try and make this work. Slap 15 on there. Then we're going to look at their total debt, balance sheet. Again, ticker terminal is great because they know exactly what value investors are looking for when they go to value a company. So if we scroll down, come up here, you'll see total debt. It's at about 22.6 billion. If we're doing a full valuation, I'm not going to use that number. I'm just going to use contractual commitments for debt. So lease obligations, we're going to have to discount that back. And a lot of things that, I mean, when you read the 10K, there's a section that says contractual commitments, and I think it's best advised to discount all those debts back to present value today. But yeah, simplicity. Trying to stay focused here. My ADD is kicking in. We're going to do 22.6 billion for debt. If you look at their cash, we're going to go back to our balance sheet and cash and short-term equivalents. So they have a lot of liquidity. That's really good, especially relative to their debt load. So it's showing about 71 billion. Plug that in. Then we're going to divide it by the shares outstanding. If you're using ticker terminal, you just scroll down. My face is floating all over the place here. It's about 2.7. One quick note on that. These are ADRs, American Depository Receipts. I think that's what they're called. And if you read the 10K, one American ADR, one ADR, is equal, I think, 7 or 8 shares in the Hong Kong market. But if you buy the ADRs, you don't get voting rights. Now, if you're a small guy like me, it doesn't mean anything. Like, I'm not voting. I have no power, but just something to think about. And then we're going to get our net cash or net debt position. And this is important because we're going to add this back later on in the valuation. But essentially, we take all those numbers and we come up with our array of numbers over here. And so essentially, this is growing this number right here. This FCF, free cash flow, we're taking this number and we are adding our growth rates. And then we have our present value. So we take the free cash flow and we discount it back to that minimal accepted rate of return, or a discount rate, interest rate. There's a lot of synonyms you can use. Again, if you want to know the mathematics here, I recommend either digging into the spreadsheet itself, I'll probably make it available in the description. If I forget, leave a comment, let me know. Or just watch a YouTube video. There's so many out there. But essentially, you take the present value of all that cash, Warren Buffett style. The intrinsic value of a company is the discounted present value of all future cash flows. So that's exactly what we're doing here. And then we slap on that terminal value of 15. And we add, I misspoke. This is the number times the terminal value. Then this, we add back the cash and debt. So if this was the other way, if this was negative, let's say they had a lot of debt, that's going to impact the intrinsic value, because as a business owner, which that's what we are when we buy a share of stock, we're responsible for the debt. So this will be down if that is negative. But then if you want to figure it out on a per share basis, you can. I don't think Warren Buffett does it. He just looks at this number alone. But if you want to, you just take the intrinsic enterprise value that you came out with and you divide it by the shares outstanding. And that's essentially what you think it's worth based off of the growth rates that you came up with. This margin of safety stuff is how you can assess your downside risk and upside potential. I'll probably make a video on how important that is. Well, actually, I'll talk about it real quick. If we buy, let's say Alibaba is trading at $300 a share like it was earlier, and we buy it at $305. So we bought a great company at a fair price. Well, what if China, captures Jack Ma again? If you don't know about that, go read about it. It's pretty disturbing. But, this share price is going to go down. The market's going to react, and we're going to be impacted by it. But if you buy with a margin of safety, essentially, Chamath Palihapitiya, I don't think I said that right, but he talks about the margin of safety as a way of factoring in all of that risk. So if you buy it at 152, you're pretty much baking into the cake all the potential bad news that could happen. Something to consider. I'm just going to touch on Payback Time real quick. And again, this is Phil Town in his second book. And this is essentially how much the stock costs. How do I say this? This is how much how long it's going to take for you to get your money back relative to what the stock is trading at today on the market. So you're basically doing the same thing. You're growing free cash flows, and I took all these numbers from the first spreadsheet. They're just automatically inputted into here. And you're going to use the same growth rate. You're going to get your expected free cash flow. And then you're going to take your cash, debt, and shares. And then you're going to see what it's going to be, what the cumulative free cash flow is going to be in year 8, and then divide it back to the cash and debt and shares outstanding today. And essentially what this is telling me is that if I want my money back from this investment in 8 years, I'm going to have to buy it at $208. Right now, Alibaba's at, I think, like $240 at the time of this recording. So that means it's going to be even a little bit longer than 8 years. One last quick thing on Payback Time that I think is kind of interesting is that in the book, Payback Time by Phil Town, he talks about how private equity firms, they want a payback time of 8 or 5 years. So if they buy a private company, they will only buy it usually if they think they can get their money back and start being in the green, earning just cash flow for free, basically, within 8 years. And if you can find a stock that is great, you understand it, has good fundamentals, has all the green here, and for whatever reason it's selling at such a cheap price that you can get your money back in 5 years, then that's really, really good. I found a couple in my investing career, and there were a ton during the crash last March. But it's very rare to find a target payback buy price of less than 5 years. I think I'll get into the 10 cap, which is the way Warren Buffett values a company, and the acquires multiple in a part 2 if I do one, if you guys want. If not, that's cool, but I think that's all I have. Again, this 305 number, that's what I came up with, and I'm not gonna lie, I really should show you the full valuation. I have a whole nother Excel spreadsheet that I go through, which I think might be a bit more accurate. But I think that's fair. I think 305 is fair. I've seen some videos where guys are talking about it being worth $450, $500, maybe. But based off of where it's at today and the stats that I look at on the 10K, I can't get there. I think this is a nice conservative valuation. Of course, this isn't financial advice. Do your own homework. Learn how to do discounted cash flow if you don't. But I think that's all I have. I'm not really sure how to end this, but I think I'm just going to end the video here, guys. This was fun. This was my first official stock video for the channel. I'm really excited to see where this channel goes. This is a passion of mine. I don't expect it to... My intention is not to make this a huge million subscriber channel. I'm just looking to build a community of people who are interested in nerding out over this stuff just as much as I am. And yeah, well, I hope you liked it. And until next time, guys, thanks for watching.